Hi friends, I'm recording a video to discuss your November 2022 FM paper. Some of the students found the paper a little difficult and there have been multiple requests from you guys to discuss this paper. So I thought I'll record a separate video for this. We're going to discuss all the questions in this paper except for the theory question. Going through the paper, I felt it is not a very simple paper, but it's not very difficult also. Out of the practical questions, I found one question to be very tricky. Other questions were fairly manageable. That is what I felt. Let's anyway discuss the paper. Let's start with question 1A. K Limited has a quarterly cash outflow of 9 lakh arising uniformly during the quarter. Company has an investment portfolio of marketable security. It plans to meet the demand for cash by periodically selling marketable security. Marketable securities are generating a return of 12% per annum. Transaction cost of conversion is rupees 60. Baumol model to find out the optimal transaction size. Consider 360 days. Company's average cash balance, number of conversions, and time interval between two conversion. Go through this. I'll start explaining in a minute. Go through this. Go through the problem. Okay, this question is on working capital management. This problem came from working capital management. In that, you have an area called as cash management. In that, there was something called as a Baumol's model of cash management, which is similar to EOQ calculation. So we are going to technically use the same formula to do this problem. We are technically going to use the EOQ formula to solve the problem. So question 1A, your problem number 1A came from working capital management. In that, we have something called as Baumol's model of cash management. Baumol's model of cash management. This is not a new problem. It is there in our class material as well. Uh, Obviously, in the question, they added few more extra things, but this problem is there in our class material. So let's discuss this now. First, they've asked average cash balance. Average cash balance is average inventory formula. What is average inventory formula? Is EOQ divided by 2 in cost accounting. EOQ divided by 2. So here you will write economic or optimal transaction size. Optimal transaction size divided by 2. Whatever is the optimal transaction size, you divide by 2, you will get to know the average cash balance, which is similar to average inventory. Number of conversion is similar to number of orders. Number of conversion is similar to number of orders, which is total demand for money. We used to have annual purchase, annual demand for raw material. Total demand for money divided by the optimal transaction size or economic order quantity like EOQ. Time interval is 360 divided by number of conversion. 360 divided by number of conversion. So let's start. Economic order quantity we say, here I'll call it as optimal transaction size. Optimal transaction size is equal to square root of 2 into annual demand for money. Annual demand for money. There you used to have annual demand for raw material into transaction cost per transfer. Transaction cost per transfer divided by transaction cost per transfer divided by opportunity cost per rupee per annum. I'm repeating the formula with the EOQ approach. Square root of 2 into annual demand for raw material, here it's called annual demand for money, into ordering cost per order, here it's called transaction cost per transfer, divided by inventory carrying cost per unit per annum, here it's per rupee per annum. Per rupee per annum, square root of 2 into annual demand is 9 lakh. 9 lakh is the quarterly outflow. 9 lakh is the quarterly outflow. So 9 lakh into 4, 36 lakhs. Transaction cost. The transaction cost of converting the investment to cash is rupees 60. That is rupees 60. Opportunity cost per rupee. Opportunity cost per rupees. 1 rupee opportunity cost we want to calculate, which is 12%. For 1 rupee, it's 12%, which is 0.12. 2 into 36 lakh into 60 divided by 0.12. Square root of 2 into 36 lakhs into 60 divided by 0.12. Divided by 0.12. Optimum transaction size is rupees 60,000. This is not the average cash balance. This is the optimum transaction size, or like EOQ. Like the EOQ, optimum transaction size is 60,000. Average cash balance, like average inventory, average cash balance is equal to optimum transaction size, EOQ by 2. EOQ by 2. 60,000 by 2. Average cash balance 60,000 by 2, rupees 30,000. 60,000 divided by 2, rupees 30,000. Rupees 30,000. Then next is number of conversion. Number of conversion. Annual demand for money. There it used to be annual demand for raw material. Annual demand for money divided by economic order quantity. Annual demand for raw material divided by economic order quantity. Here it's annual demand for money by optimum transaction size. 36 lakh divided by 60,000. 60 conversion or 60 transfer. 60 conversions in a year. 60 conversions in a year. 60 conversions will have to be done in a year. Third is time interval. Time interval between two conversion. 360 frequency of ordering divided by number of conversion. 360 by number of conversion. Every 6 days I will do a conversion. That is, I'll convert the money from your marketable security into cash, spend that money, then do another transfer. Every 6 days it will keep happening. Every 6 days it will keep happening. So a fairly simple question which came for 5 marks in exam. The only challenge which students would have faced in this question is, this is not something which is frequently tested in exam. So that could be one challenge for the students. Okay, let's move to the next question, which is on question 1B. Following figures are related to the trading activities of M Limited. Total assets, debt to total assets, interest cost, direct cost, operating expenses. Goods are sold to customer at a margin of 50% on the direct cost. Tax rate is 30%. You are required to compute NP margin, net operating profit margin, return on assets, return on owner's equity. Go through this. Go through the problem. Go through the question. Okay, so this problem is on ratio analysis where they have asked us to compute some specific ratio. Sometimes the question can even ask for a P&L and balance sheet, but this problem is slightly on the simpler side. They've just asked for few specific ratios to be calculated. One is net profit margin, net operating profit margin, return on assets, and return on owner's equity. Let's first write the formula for each of this here. Net profit margin is NP by sales, net profit by sales into 100. Net operating profit margin, operating profit is EBIT. So EBIT by sales into 100. Return on assets is how much are we earning on assets. I think the ICA solution has multiple formulae. What I had told in the class is PAT by assets into 100. Net profit after tax by assets into 100. Return on owner's equities EAES by equity. EAES by equity into 100. So in order to do this question, somewhere I will need the income statement to be done, because once the income statement is done, that can give me sales figure, that can give me EBIT figure, that can give me net profit figure, that can give me EAES figure, that can give me PAT figure. So most of the item is going to come from my P&L. So somewhere we'll have to first prepare the P&L. Once we prepare the P&L, I think almost the problem will get over. So let's try to do income statement of M Limited. So question 2 or 1B. 1B is from ratio analysis. I felt this question also to be simpler. Nothing very tricky in this question. If there's something tricky in a problem, I will say, it's not that I'm going to say everything is simple. This problem, according to me, was on the simpler side. Particulars, amount, income statement. Heading is income statement of M Limited. Income statement of M Limited. Particulars and amount. Let's write the format first. We will start with sales. Subtract direct cost. Write the format along with me. From sales, we will subtract direct cost. They have talked about a term called as direct cost. Direct cost is basically something which goes into your trading account. So sales less direct cost is called gross profit, less operating expenses. This is also called as indirect expenses. Operating expenses is also called as indirect expenses. Less operating expenses, you will get EBIT. EBIT less interest, EBT less tax at 30%, EAT or EAES. There's no preference dividend. There is no preference dividend. This is the format. This is the format. Sales less direct cost, write the format. Gross profit less operating expenses, EBIT less interest, EBT less tax, EAT slash EAES. EAT slash EAES. Total asset figure is 10 lakh. Debt to total assets is 50%. So debt to total asset is 50% means debt figure is 5 lakhs. I'm not doing a separate calculation for this. Debt figure is 5 lakhs, which means equity figure is also 5 lakh. You will use this later. Debt is 5 lakhs. Equity is also 5 lakh. Somewhere the equity figure would be used later on. Debt is 5 lakhs. Equity is also 5 lakhs. Interest cost is 10%. Interest cost is 10% per year. So interest 5 lakh into 10%. 5 lakh into 10%, 50,000. 5 lakhs into 10%, 50,000. Interest is 50,000. 5 lakhs into 10%. Interest is 50,000. Direct cost is 10 times of interest cost. Direct cost is 10 times of the interest cost. So 50,000 into 10. 10 times 50,000 into 10. Direct cost is 10 times of the interest cost. 10 times of the interest cost. 5 lakhs. Operating expenses 1 lakh. Operating expenses 1 lakh. Direct cost is 5 lakhs. OPEX is 1 lakh given in the problem. Goods are sold to customer at a margin of 50% on the direct cost. So whatever is the direct cost, on that I add another 50% margin and sell it to customer. So 5 lakhs plus extra 50% profit on the direct cost. Profit on the direct cost. So sales value is 5 lakh into 1.5, which is 7 lakh 50. 7 lakh 50. This is almost over now. GP is 250. EBIT is 1 lakh 50. EBT is 1 lakh. Tax is 30%. EAT is 70,000. Right till this, I'll wait. Please complete the income statement first. Let me know if there are any doubts here. Any doubts on the income statement, please let me know. Complete this. Complete the income statement part. Okay, I hope you have done. In case you're yet to do, you can pause the video at times and then note it down at places if you feel you have not noted down something. Net profit margin is equal to net profit, which is profit after tax, by sales into 100. PAT by sales into 100. 70,000 by 7,50,000 into 100. NP margin 70,000 by 7,50,000. 9.33%. NP margin, PAT by sales 70,000 by 7,50,000. 9.33%. NP margin 9.33%. Net operating profit margin. Net operating profit margin, which is EBIT by sales. Operating profit margin is EBIT by sales. EBIT by sales 150 by 750 into 100, which is 20%. 1 lakh 50 by 7 lakh 50 into 100, 20%. 20%. Net operating profit margin. Operating profit is EBIT. Operating profit is EBIT. Return on assets. ICA solution I think has multiple formulae, but I feel this is better. PAT by assets into 100. PAT by assets into 100. 70,000 by 10 lakh. First line of the question had the asset figure. 70,000 by 10 lakh. PAT by assets into 100. 70,000 by 10 lakh. 7%. PAT by assets into 100. net profit by assets into 100, then ROE is equal to EAES by amount of equity. EAES by equity into 100. EAES, which is pat in this question because there is no preference dividend. There is no preference dividend in the question. So 70,000 divided by equity figure was here. When I did this analysis, debt is 5 lakhs, 50%, balance is equity. Balance is equity, which is another 5 lakhs into 100. 14%. I think an extremely simple question once the income statement is done properly. Once you do the income statement properly, it will become an extremely simple question. It is going to become an extremely simple question once the income statement is done properly. I hope you have completed this. Complete this. In case there are doubts, you can let me know. Okay. If there are any doubts, please let me know. Else, I'll proceed to the next question. Okay, let's move to the next question. Let's move to the next problem. Okay, following is the extract of balance sheet of measures KD Limited, particulars and amount. Ordinary shares 5 lakh, share premium 1 lakh, retained profit 6 lakh, 8% preference share 4 lakh, 12% debenture 6 lakh. Ordinary shares are currently priced at rupees 39 x dividend. Preference share is priced at rupees 18 cum dividend. Debentures are selling at 120% x interest. Applicable tax rate is 30%. Cost of equity is 19%. WACC on the basis of market value. Go through the question. I felt this question to be slightly tricky because of one adjustment. We have done that adjustment in the regular class, but not sure how many of you would have factored that or would have remembered that in an exam condition. So one place alone students could have struggled in this question. Otherwise, no major difficulty, but yes, this is not a straightforward simple question. There is some tricky element in the problem. Go through this. Okay, let's start discussing this. They've asked for WACC computation based on market value. So WACC computation, we used to follow format source, cost, weight, product. I'm going to use the same format only. Cost of equity is given in the question. So cost of equity or your share premium, retained profit, everything is going to be same. Equity and retained earnings is going to be same. So I'll show it as a single line item only, cost of equity, because your cost of retained earnings can be different from cost of equity if there's some flotation cost and other things. Preference, you'll have to calculate cost of preference. Debentures, you'll have to calculate cost of debentures. So let's put this in the format we use normally. Working note 1, computation of WACC. This question, I think question 1C. is from cost of capital chapter. Is from cost of capital. I can say this to be slightly tricky. This problem to be slightly tricky because of one adjustment alone. Source, cost, weight, product. Source, cost, weight and product. Source, cost, weight and product. Source, cost, weight and product. Equity, preference and debentures. These are the items we have. Equity, preference and debentures and total. Equity, preference, debentures and total. We'll go item by item. Equity, preference, debentures and total. Cost of equity given in the question 19%. Cost of equity given in the problem 19%. Equity given in the question 19%. Weight of equity is 5 lakh divided by 10, you have 50,000 shares. There's no separate value for premium and retained profits because market values everything together. 5 lakh divided by 10 is 50,000 and the ordinary share is equity shares is valued at 39. What I need to multiply is always the ex dividend value. We should use ex dividend value, ex interest value everywhere because the cum dividend value will have the component of dividend added on top of it, which would get paid in few days. So every share in practical world at some point of time will start quoting at the ex dividend price moment dividend is paid. So the real price of the share is always the ex dividend price. The real price of the share is always the ex dividend price. It's not the cum dividend price. In your accountancy, you could have learnt about how to split the value into ex interest and cum interest or ex dividend and cum dividend. Here it's ex dividend, so I'll directly use it 50,000 into 39. 50,000 shares into 39. 50,000 shares into 39. Product is weight into 19%. Weight into 19%. Weight into 19%. 19 lakh 50,000 into 19%. Into 19%. Okay, coming to cost of preference. Cost of preference, which is not directly given. So let's do that. Cost of preference is equal to KP is equal to preference dividend divided by net proceeds. Net proceeds for an existing issue. Net proceeds for an existing issue is current market price. Net proceeds for an existing issue is current market price. Is current market price. So preference dividend per share is 25 into 8%, 2 rupees into 100 to express in percentage. Net proceeds is current market price, which is 18, but cum dividend. Cum dividend means you'll have to remove the dividend value. Cum dividend means you'll have to remove the dividend value and get the ex dividend value. Get the ex dividend value. This was the only tricky adjustment in exam scenario. 18 cum dividend. So 18 minus 2. Technically 2 by 16, which is 12.5%. 2 divided by 16, 12.5%. 12.5% is the cost of preference. Is the cost of preference. 12.5 and the net proceeds value 16. So number of shares is 4 lakhs divided by 25, you will have to use the ex dividend value even for the weight calculation or the cost calculation. 4 lakh divided by 25 is 16,000. 4 lakh by 25 is 16,000. Let me just check it. 16,000. 16,000 into 16 rupees. 16,000 into 16 rupees. Ex dividend value, we'll have to consider the ex dividend value. 16,000 into 16. This into 12.5%. 32,000. Next is cost of debentures. Cost of debentures is equal to interest after tax divided by interest after tax divided by net proceeds. Net proceeds is for an existing issue, current market price. Net proceeds is current market price. Interest after taxes face value into the coupon rate, which is 12 rupees into 1 minus 0.3 after tax. Tax rate is 30%. Yeah, 12 into 1 minus 0.3. 12 into 1 minus 0.3. 1 minus 0.3. Net proceeds. Net proceeds is current market price, which in this case is net proceeds is current market price, which is 120%. 120% of what? It will be 120% of face value. 120% of face value. 120 into 100. So net it is 8.4 by 120. 7%. 8.4 by 120. 7 percentage. 8.4 divided by 120. 7% is the value. So cost is 7. Weight is 6 lakh divided by 100, which is 6,000. 6 lakh divided by 100 is 6,000 into 120. Into 120. That's all. I think I don't have anything to explain. Sum of product, sum of weights, WACC is equal to sum of product divided by sum of weights. Sum of product divided by sum of weights. 452 900 2926. We'll do maybe 2 decimal. 15.48%, or you can even leave it as 15.4785%. 15.48% is the WACC based on market value. The only tricky part I felt in this question was on adjustment of X interest, come interest, X dividend, come dividend. Interest, no adjustment was there, but there was an adjustment on the dividend side. Whatever they had given was the come dividend value, you had to calculate the X dividend value. You had to compute the X dividend value and then do the calculation. Any doubts, let me know. The solution is this 452 900 by 2926. 452 900 divided by 29 lakh 26,000. I hope this is clear. If there are doubts, let me know. Any doubts, let me know. Okay, I'll take a break of some 5 minutes and then continue. Okay, let's proceed to the next question. 1D, determine the risk adjusted NPV of the following projects: outlay, project life, inflow, coefficient of variation, Company selects the RADR on the basis of coefficient of variation. Which project should be selected by the company based on risk adjusted NPV? Go through this. I think this was the most simplest of the problems in exam. In this paper, this was the most simple question. Nothing much is there in this question. Go through this. I'll discuss this. You go through the problem first. Okay, this question is asking us to calculate risk adjusted NPV. So this has come from risk analysis and capital budgeting, where the discount rate will vary based on the risk. The discount rate will vary based on the risk. How do you measure risk? You measure risk through RA, you measure risk through coefficient of variation. So based on CV, you will have the risk adjusted discount rate and accordingly complete the calculation. So this is the most simple of the lot. Question 1D came from risk analysis in capital budgeting. Simple, extremely simple. In fact, this is the easiest of the lot. Will not take more than 4-5 minutes. Particulars and 3 projects. Even the annuity factor is given in the question, so there's nothing to be done. Particulars and 3 projects. Particulars and 3 projects. Your NPV is equal to inflow minus outflow. PV of inflow minus PV of outflow. NPV is equal to PV of inflow minus PV of outflow. Annual inflow. Annual inflow. Sorry, outlay. Sorry, inflow is 30,000. 30,000, 42,000, 70,000, 30, 42, and 70. The discount rate would depend, because you'll have to discount this inflow. You'll have to discount the inflow, which will depend on coefficient of variation. So CV, coefficient of variation, 2.2, 1.6, 1.2. Coefficient of variation, 2.2, 1.6, and 1.2. Discount rate, RADR, risk adjusted discount rate. RADR, risk adjusted discount rate. For 2.2, according to the table, you will have to use 25%, which is a very high discount rate. According to the table, 2.2 greater than 2, 25%. 1.6, 18%. 1.2, 16%. Lower CV means lower risk. Lower risk means lower RADR. Lower RADR. For this annuity factor, for whatever RADR, comma life is 5 years. RADR, comma life, the annuity factor is also there in the question. The annuity factor is also there in the question. For 25%, 2.689. For 18%, 3.127. And for 16%, 3.274. The annuity factor 2.689, 3.127, 3.274. Present value of inflow, which is your annual inflow into the annuity factor. Annual inflow into the annuity factor. annual inflow into the annuity factor, PV of inflow. So very simple question. PV of inflow, PV of outflow, which is nothing but the outflow. PV of outflow is nothing but the outflow. PV of outflow is nothing but the outflow. 70,000, 120, 220, and difference is called risk adjusted NPV. Inflow minus outflow. Inflow minus outflow. We will go ahead with the highest project. They said which project is to be selected. I'll select project B because that has the highest risk adjusted NPV. Project B has the highest risk adjusted NPV. Highest risk adjusted NPV. I hope this is clear. Nothing much is there in this question to discuss. In fact, extremely simple question. It's a fairly simple problem. Project B has the highest risk adjusted NPV. Highest risk adjusted NPV. Let's move to the next question. When I did your ratio analysis, that part I was explaining that you can have multiple answers. So they have given multiple answers, but in the finally they have selected this. Finally, what was selected is this answer by us. We have done this, and this adjustment I was talking about. Let's move to question 2. Following information is available for SS Limited: PV ratio, operating leverage, financial leverage, loan, post-tax interest rate, tax rate, MPS, P multiple. You are required to prepare the profit loss statement and find out the number of equity shares. According to me, this was also very simple. Nothing tricky is there in this question. Go through the problem. Go through the problem. Nothing tricky there in this question. Okay, this is a question on reverse working through the leverages. We have done similar question in the class. We'll do the EBIT EPS format, that is sorry, detailed format, profit loss statement fully asked. Number of equity shares will come in that statement itself. So let's put the statement first. Profit and loss. So question 2, this has come from leverages. Simple. Leverages simple. Particulars and amount. Let's write the format. It starts with sales less variable cost, contribution, fixed cost, EBIT, less interest, EBT, tax, EAT. Preference dividend is not there, so EAT / EAES. Number of equity shares, this was one of the requirement which will come out in the format. EPS, P multiple, MPS. Somewhere in the format you will get the number of equity shares also. Profit and loss statement starting with sales less variable cost, contribution less fixed cost, EBIT less interest EBT, less tax EAT or EAES, number of equity shares EPS, P multiple and MPS. We'll capture whatever data is available first and then try to get to the missing data. We'll then try to compute the missing information. First, let's write the format first. Starting from sales till MPS. Starting from sales goes on till MPS. So PV ratio is 30%. I'm just writing only thing is contribution is 30% of sales. I don't know, I'll come to the numbers later. PV ratio 30%. Operating leverage we cannot use. Financial leverage we cannot use as of now directly in the format. Loan is 1,25,000. Post tax interest is 5.6. You will pay interest as per the pre-tax rate. The interest is paid as per the pre-tax rate. The post-tax rate is 5.6. So pre-tax rate is, I'm doing calculation here itself. Pre-tax rate is equal to 5.6 divided by 1 minus tax rate. 5.6 divided by 1 minus tax rate. So the normal interest cost is 8%. You will have to pay 8% interest on loan of 1,25,000. You will have to pay 8% interest on loan of 1,25,000. So interest is 125 into 8%, 10,000. 1,25,000 into 8%. How 8%? 5.6 divided by 1 minus tax rate. I've just captured that alone. Others will see it later. 1,25,000 into 8%, 10,000. Tax will see it later. I think other information I have is MPS is 140. Market price is 140. P multiple is 10 times. Balance will do reverse working and other things. We will do reverse working and other things. Now, in the class, I would have said if leverages are there, that is your formula for OL is contribution by EBIT. FL in this question is EBIT by EBT. Preference dividend adjustment is not there. Otherwise, the formula is EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. So, all that is not there. OL is contribution by EBIT. FL is EBIT by EBT. If you have either contribution or EBIT or the in-between item, that is contribution or EBIT or fixed cost, you can use OL and get all the three. One of them only you need. Or OL is not possible because I don't have all the three. EBIT, interest or EBT, if one of them is available, we can calculate the other thing. So I'm going to use financial leverage, get EBIT, EBT, a problem will almost get over. Problem will almost get over. We are going to use the financial leverage and get, because interest is available. So let's start now. Right, financial leverage is equal to EBIT divided by EBT. Financial leverage is equal to EBIT divided by EBT. 1.50 is equal to EBIT divided by EBIT minus interest. EBIT minus interest, which is 10,000. EBIT minus interest, which is 10,000. This goes the other side. You keep writing along with me. This goes the other side. 1.50 EBIT minus 15,000 is equal to EBIT. This goes the other side. 0.5 EBIT is equal to 15,000. Problem is almost over now. EBIT is equal to, very simple question again, 30,000 is the EBIT number. 15,000 divided by 0.5. 15,000 divided by 0.5, 30,000 is the number. 15,000 divided by 0.5, EBIT number is 30,000. EBIT number is 30,000. EBIT number is 30,000. So I put this 30,000 here. I hope you have noted this. Let me know in case you're still writing this. EBIT number is 30,000. Let me know if you're still writing this. EBIT is 30,000. So that's all. Let's close this. EBT is 20,000. EBT is 20,000. Tax is 30%. Tax is 30%. 6,000. EAT is 14,000. Reverse working, EPS multiplied with P multiple is MPS. So I can say MPS divided by this is EPS. EPS into P multiple is MPS. Hence EPS is MPS divided by the P multiple. And number of shares is balancing figure, which is the part 2 of the question. Part 2 wanted number of shares to be calculated. Number of shares is balancing figure. 14,000 by 14,000 shares are there. 14,000 divided by 14,000 shares are there. Divided by 14,000 equity shares are there. We can use the formula of operating leverage. OL is equal to contribution by EBIT. OL given in the question is 2 is equal to contribution by 30,000. 2 is equal to, because I said once you have one of those three items, you can get the all other. So earlier I did not have EBIT. Moment I got EBIT, I can get fixed cost and contribution using operating leverage. So contribution is equal to 2 into 30,000, 60,000. Fixed cost is balancing figure. Fixed cost is balancing figure. Contribution is 60,000. Contribution is 60,000. So 30% is contribution of, your contribution is 30% of sales. Contribution is 30% of sales. Sales is this divided by 30%. So the entire statement is over now. Entire statement is over. Part 1 and part 2 both are done here. Part 1 and part 2 of the question both are taken care in this format. 60,000 by 30% is the sales figure. Variable cost is 140. Variable cost is 140. Let me know if there are doubts here. A fairly simple question. In fact, in the class itself, now when I'm solving it along with you, I've taken around only some 12-13 minutes. If you do at your end, it can be even faster also, because here I have to explain every calculation. So this was a 10-mark question which could have been done in 10 minutes in exam. In 10 minutes, you could have completed this in exam. I hope this is clear. Hope this is clear. Let's move to the next question. The statement is here. Let's move to question 3. Let's move to question 3. This I felt was among the trickiest of the lot. Trickiest because it involves a lot of calculation and one concept is needed. A firm is in need of a small vehicle to make deliveries. It is intending to choose between two options. One option is to buy a new three-wheeler that would cost 1,50,000, will remain in service for 10 years. Other alternative is to buy a second-hand vehicle for 80,000 that could remain in service for 5 years. Thereafter, the firm can buy another second-hand vehicle for 60,000 that will last for another 5 years. Scrap value of the discarded vehicle will be equal to its WDV. Firm pays 30% tax, claim depreciation at 25% on WDV basis, cost of capital is 12%. You are required to advise the best option. go through this. Go through this question. Okay, this problem is on capital budgeting. The problem is on capital budgeting. The challenge this question gave is, you are planning to buy a machine or vehicle. You have initial outflow. In between, no inflow is given, because this is a project where only outflows are there. If you have only outflows, if you remember in class, we used to do PV of outflow and select a machine which has a lower PV of outflow, and in case they have different life, then we used to do EAC, equated annual cost. Now the only adjustment in this question is, you have an outflow, no inflows are given, but you will have to claim depreciation under WDV method. Claim depreciation. If you claim depreciation, you will get a tax benefit on the depreciation. There will be a tax benefit which is like an inflow. On the depreciation, there is going to be a tax benefit which is the inflow of the project. On the depreciation, there is going to be a tax benefit which is the inflow of the project. So that alone you will have to take care. You will have to calculate depreciation and take the tax benefit of the depreciation, which is called tax shield. On the depreciation, you are going to get tax benefit. We had a similar problem in class where there was one problem on where the company wanted to take a machine on lease or something, but I think in that question the tax rate was not there. I don't remember it exactly, but if tax rates are not there, then depreciation adjustment is not needed. But if tax rate is there, you will have to claim depreciation and the tax benefit on depreciation. So one is to go for a new machine, second is to go for a second hand vehicle which will last for 5 years. You will buy another vehicle that will last for another 5 years. Here also you are going to claim depreciation. Here also you are going to claim depreciation. One good part is the scrap value will be equal to WDV. If scrap value is equal to WDV, net salvage value is equal to salvage value, because no capital gain, no capital loss will be there, because whatever scrap value, which is your sale value, will be equal to the WDV, which is the book value. Sale value and book value is going to remain same. Let me first analyze the first option, which is buying a new three-wheeler. Second option is buying a second-hand vehicle. So question 3, this can take a little bit more time. Question 3, investment decision. Investment decision. Question 3, investment decision. Slightly on the tricky side. Working note 1, computation of PV of outflow. PV of outflow if new machine is purchased. PV of outflow if new machine is purchased. New machine is purchased. Note 1, depreciation tax shield. Depreciation tax shield. Depreciation tax shield. Because tax rates are there. If tax rates was not there in the question, if tax rates were missing, I wouldn't do anything on depreciation. Year, opening balance, depreciation, closing balance, and tax shield. What is tax shield? Is depreciation into the tax rate. Whatever is the depreciation into the tax rate is indirectly your inflow. Is indirectly the inflow. Depreciation into the tax rate is like an inflow for us. Is like an inflow for us. Here they can make it even more complicated by giving certain expenses also. If they give you expense in the problem, then expense is an outflow. On the expense also you'll have a tax sheet. So if there was an expense, my net cash flow is depreciation tax shield, expense tax shield minus the expenses. Expense is my outflow. Expense is my outflow, or you can calculate inflow outflow. That's your wish. You can say expenses minus the depreciation tax shield minus the expense tax shield is my net cash outflow. This I've calculated as net cash inflow in this scenario. You have 10 years. I may do it a little faster in Excel, so you can pause the video at times if you want. 1 to 10. You can pause the video if you need. 1 to 10. 1,50,000 is the cost of the asset. Depreciation rate is 25% under WDV method. So 25%. 25%. Closing balance 112,500. 25% depreciation. Closing balance 112,500. Take this to be the opening. Again 25%. Closing balance. The cycle will keep going on. Keep doing this. The cycle will keep going on. We'll keep claiming 25% depreciation. We'll keep claiming 25% depreciation. Whatever is the closing balance at the end of 10th year, that is the salvage value. Closing balance at the end of 10th year is the salvage value. Claim depreciation for all the 10 years. Depreciation for all the 10 years. Tax shield is, okay, I'll give some time. Quickly note it. Quickly note it. We are claiming depreciation at the rate of 25%. Tax shield is depreciation into the tax rate. I think tax rate is 30%. Depreciation into the tax rate. Depreciation into the tax rate. This is an inflow every year. This is like an inflow every year. Depreciation into the tax rate, because I will save so much of tax every year. I'm going to save this amount of tax every year. Depreciation into the tax rate. Depreciation into the tax rate. This is the amount of tax saving every year. Amount of tax saving every year. Note 2. Computation of PV of outflow. NPV cannot be computed because you'll have negative NPV only. There is no inflow here. Year cash flow PVF at 12%, DCF. Year cash flow PVF at 12% and DCF. Starting with year 0, 10 years calculation. Starting with year 0, 10 years calculation. 10 years calculation. Cash flow given in the question is 1,50,000. I'll write outflow as positive here because we are calculating PV of outflow 1,50,000. Outflows are written as positive items. Inflows will be written as negative item. 1,50,000 is my initial outflow. First year inflow. Inflows will be written negative. 11,250, 8,438. It goes on like this. Last year, this and the scrap value. This and the scrap value. What is scrap values? 8447. Last year is 845 and 8447. Both are inflow. We write it as negative. We write it as negative. 845 plus 8447. 845 plus 8447. 12% is the discount rate. The factors are given in the question. You can copy paste from there itself. I'm just done it in the Excel, but we'll have to ensure that the factors matches with what is there in the question. I think there is some variation. I don't know. I'm writing whatever is there in the question. I'll write whatever is given in the problem. Whatever factors are given in the question, I've copied them. Your depreciation tax shield is an inflow. Inflow is written as negative here. Outflow is written as positive. Last year there are two inflows. One is your depreciation tax shield and the salvage value. Our question has clearly said salvage value is equal to the WDV value. DCF you put a total, that is called PV of outflow. Quickly close this. This is more of a formality. More of a formality. Quickly close this. PV of outflow. PV of outflow. Quickly close this calculation. More of a formality. Present value of outflow. PV of outflow. I'll wait for some time. Quickly close this. PV of outflow. This is for the first option. PV of outflow 117,450. 117,450. You're buying a machinery for 1,50,000. 10 years you claim some depreciation and salvage value that reduces the value and it becomes 117,450. 117,450. Similar calculation we will do now for the second option. I think I'm going to keep it to the same format. I'm going to capture exactly the same thing. Working note 2, computation of PV of outflow if second hand machine is purchased. If second hand machine is purchased. Note 1 depreciation tax sheet. Note 1 depreciation tax sheet. Note 1 depreciation tax sheet. The rate remains same 25%, but here you will buy and sell it at the end of 5 years and then buy another machine. So initial cost is 80,000, 25% depreciation, 60,000 closing balance. Depreciation tax shield is 30% of depreciation. Goes on like this till 5 years. Go on till 5 years like this. 5 years is the usage. Go on like this for a period of 5 years. Go on like this for a period of 5 years. At the end of 5 years, I will sell this for 18,984. I'll sell this for 18,984. At the end of 5 years, I'll sell this machine. This will come as an inflow in my cash flow computation. At the end of 5 years, I am going to sell this for 18,984. Then you will buy it for 60,000. Same, claim 15%. Claim 15% depreciation. Claim 15% depreciation. Sell at the end of 10 years for 14 to 38. I don't have anything much to explain here. You buy a machinery for 80,000, claim depreciation at the rate of 25% for 5 years, sell it at the rate of 18,984. Then buy another for 60,000, use it for 5 years, sell it at the rate of 14 to 38. Sell it at the rate of 14,000 to 38. Claim depreciation and sell it at the rate of 14 to 38. In case you have not noted down, you can pause the video and complete noting it, because it's the same calculation. I don't want to spend time much on this. Year 0 inflow is, or outflow, technically outflow is 60,000, outflow is 60,000, sorry 80,000, outflow is 80,000. Year 0 outflow is 80,000. First year, whatever is your depreciation tax shield is inflow, we write it as negative. We write that as negative 6,000, negative 4,500, negative 3,375, negative 2,531. Fifth year is where I may spend a little bit of time. Fifth year is negative 1,898 and salvage value negative 18,984. You will get 1,898, you will get 18,984, and buy the new machinery for 60,000. Buy the new machinery, that is the second hand machine. You'll have to buy another machine for 60,000. So this year, negative 1,898, negative 18,984 plus 60,000, plus 60,000, plus 60,000. Why plus 60,000? Outflows are written as positive. Outflows are written as positive. Outflows are written as positive. Year 6 it continues again. 4,500, 3,375, 2,531, 1,898. Last year 1,424 and 14 to 38. You will sell it at the rate of 14 to 38. You will sell this at the rate of 14,000 to 38. 14 to 38. Whichever has lower PV of outflow, I'll go ahead with that. Whichever has lower PV of outflow, we will go ahead with that machine. Let me know if there are doubts here. Any doubts on this, please let me know. Involves a lot of calculation, can take more time at your end also. It can take more time at your end. The problem had only outflows and the depreciation tax benefit. Depreciation tax benefit. I'll go ahead with alternative 2, which is buying the second hand machine. I'll prefer buying the second hand machine. Any doubts? The depreciation tax shield is computed. You will see here. For the first machine, we got 117,450. ICI solution is 117,452. A small difference. That's okay. That's rounding off. Second machine, 78,685. They've got 78,686. So net, I'll go ahead with buying of second hand vehicle. I'll go ahead with buying of second hand vehicle because that is better. That is better. Okay, let's move to the next question, which is again on capital budgeting. Similar questions we have done in the class. It's there even in the ICI material. So this is a fairly simple question. A hospital is considering to purchase a diagnostic machine costing 80,000. Life is 8 years. Salvage value 6,000 at the end of 8 years. Annual cost is 7,500. Revenues of 40,000 for 8 years. Outsourcing the diagnostic work and earning a commission income of 12,000. Consider tax rate of 30% and discount rate as 10%. Whether it would be profitable to purchase the machine. Give your recommendation as per NPV method and present value index. Present value index is profitability index. Under two situations, commission income is 12,000 per annum before tax. Commission income is 12,000 per annum net of taxes. Go through this. We have done similar problems in class as well. Just one new adjustment or one different approach they've asked in the question. Go through this. Okay, in this question, I am planning to buy a machine. So this machine is going to do some diagnostic test. That is, it will take care of certain test which needs to be done in a lab. Normally, you go to a hospital, you will want some scans to be done, some testing to be done. So the machine is going to do that. As of now, you are outsourcing this thing and getting a commission income of 12,000. So you are getting this. So once you start buying this machine, this will become an opportunity cost. The only thing is this 12,000 is before tax and net of tax. If it's before tax, you will have to subtract this when you calculate PBT. If it's net of tax, you'll have to subtract this after calculating CFAT, consistency principle. This is an opportunity cost which needs to be subtracted. When do you subtract is the important part. You can either subtract it at a PBT level when this commission income is before tax, and when it is net of tax, you will subtract this after getting CFAT. So otherwise, there's nothing much. Initial outflow is 80,000. In between flow is what I'll calculate now. Working note 1, in between flow, working note 1, in between flow. Okay, question 4, this is on investment decision. So second question which has come from investment decision, kind of simple, nothing much is there, nothing much is there in the question. It's kind of a simple question. Particulars, commission before tax and commission is after tax. 12,000 is the opportunity cost. Why is it opportunity cost? Because you will lose this. You are going to lose this moment you start getting this diagnostic machine. So this 12,000 is an opportunity cost. Where should it be subtracted is the only situation. Where should I subtract this is the only analysis to be done. Revenues, 40,000, revenues 40,000 less operating cost, revenues 40,000 less operating cost and less commission. Commission is an opportunity cost. Commission is an opportunity cost. I will lose this commission income moment I buy this machine. Commission is an opportunity cost. If it's before tax, subtract it here. Not to subtract. I'll not subtract it here. I'll calculate CFAT and then subtract it. This will lead to difference in answer. Commission opportunity cost, depreciation, which is cost is 80,000, salvage value 6,000, cost is 80,000, salvage value 6,000, life is 8 years. Life is 8 years. Profit before tax, profit before tax, profit before tax 11,250 and 23,250. PBT less tax at 30%, profit after tax less tax at 30%, profit after tax. Commission I'll factor it in sometime. Profit after tax, add back depreciation, that will also happen. and less commission, which is the opportunity cost. You'll subtract it after CF80. You'll subtract this after CF80. Add back depreciation, less commission. Depreciation is this, you're adding back this amount, and commission to be subtracted at this stage. Earlier we subtracted commission before tax, that is PBT level. Here we have subtracted at CF80 level. This will lead to difference in CF80 number. Difference in CF80 number 17,000 and 13,000. There is a difference in your CF80 number 17,125, 13,525. There's a difference in the commission adjustment, because of which the CF80 changes. In one situation we have written 17,125, another situation the figure is 13,525. In one situation we have subtracted at PBT level, another situation we have subtracted at PAT level. PBT and PAT level, complete this. Let me know if there are doubts. Okay. Computation of NPV. Computation of NPV and profitability index. Present value index is profitability index. Let me use the word present value index itself. The name is present value index, which is technically profitability index. Here, situation A, commission is before tax. Here, cash flow, PVF at the rate of 12%, DCF. Here, cash flow, PVF at 12% and DCF. I did not separately calculate net salvage value, because at the end of life, the sale value of the machine is 6,000. Book value will also be 6,000. How 6,000? 80,000 minus the depreciation for 8 years. So year 0, 1 to 8 and 8th year. Year 0, 1 to 8 and 8th year. Initial outflow 80,000. 1 to 8 is 17,125. At the end of 8th year, 6,000. At the end of 8th year, 6,000. Use the factors given in the problem itself. You can even do it as 1 to 7 years and 8th year separately you can write. I've written 1 to 8 together. 1 to 8 together. The factors are given in the question. So let me add them. 0.909, 0.826, 0.751, 0.683, 0.621, 0.564, 0.513, 0.467. Just give me a minute. The factor says 10%. Okay, discount rate is also 10%. Sorry, that's a mistake. Discount rate is 10%. Discount rate is 10%, 0.467. You'll get positive or negative NPV, whatever it turns out to be. I'll round off the figures and write. NPV 14,147. NPV is positive, which means I can go ahead with the project if the commission is before tax. I don't know about after tax part. I'll do the calculation in some time. If the commission is before tax, go ahead with the project as the NPV is positive. As the NPV is positive. Present value index, which is profitability index, inflow divided by outflow. Inflow divided by outflow. Inflow divided by outflow. We can express in times or in percentage. I think I say express this in time. Inflow, present value of inflow, 1 to 8 and 8th year inflow divided by the outflow. Decimals, 1.18. So if NPV is positive, go ahead with the project. If present value index is more than one time, again go ahead with the project. So you can go ahead with the project if NPV is positive or present value index is greater than 1, which in this case is happening. So they have asked us to answer, give your recommendation. So in this situation, I'll say go ahead with the purchase of diagnostic machine. Go ahead with purchase of diagnostic machine if the commission is before tax, because the CFAT is 17,125. The CFAT number will go down. The CFAT number will go down if the commission is after tax. I'm not sure whether it will get accepted or not. Situation B. Commission is after tax. I'll quickly do it. I'll give you time to do. So this number alone will change, which is 13,525. Negative NPV, project will get rejected. 13,525. It is 13,525. Project will get rejected because NPV will become negative. NPV will become negative. Present value index is less than 1 time. So that opportunity cost before tax and after tax will make a big difference to the solution. It is going to make a big difference to the solution. Positive NPV of 14,147, index is 1.18. Negative NPV of 5,056, index is 0.94. Index is 0.94. Let me know if there are doubts. Any doubts on this, please let me know. Hope this is clear. If you see the solution, I think that's what would have been done. They have done 1 to 7 years, that's fine. Our solution will broadly match. We got 14,147. Solution says 14,146.76. 5055 negative. We have got 5056. So they have worked with 2 decimals. We have not done 2 decimals. We have rounded off. Profitability index or NPV, both positive and greater than 1 in situation 1 and negative and less than 1, project gets rejected. Any doubts? Any doubts on this? Let's move to the next question. 5A and 5B, 2 questions are there. Let's come to 5A. Following are the cost and values for the firm A and B according to the traditional approach. Firm A, firm B, total value, market value of debt, market value of equity, expected net operating income, cost of debt in rupees, net income, which is profit after tax, or profit before tax, you can understand it either ways, cost of equity. Compute the equilibrium value for firm A and B in accordance with approach. So they have given traditional approach. We are required to follow approach, assuming that taxes do not exist. Without taxes, and the value of KE is 9.09. Compute value of equity and cost of equity for both the firms. Go through this. Go through the question. Okay, this question is from capital structure theories, approach without taxes. For doing capital structure theory, I had a format which starts with EBIT, less interest, EBT, leave a line, cost of debt, cost of equity, cost of capital, leave a line, value of debt, value of equity, value of firm. This is without taxes. If you are following approach without taxes, both levered and unlevered firm will have same value. The value is going to remain same. Let's put it in the format we normally follow. Again, I felt this question to be simpler only. Question 5A. This came from capital structure. Came from capital structure. Kind of a simple or an easy question. Particulars Some data points are given. I'll explain what are those data points, what is the use of that in some time. Firm A, firm B, without taxes format. The format will give you the answer also. The format is going to give you the answer as well. EBIT less interest, EBT, tax is not there, cost of debt, cost of equity, cost of capital, value of debt. This is a format we normally use. Value of equity, value of firm. Everything will automatically get calculated. I say I've done it in slightly complicated manner. Everything will come out from this format itself. Firm A and firm B, a bit less interest, EBT, cost of debt, cost of equity, cost of capital, value of debt, value of equity, and value of firm. I'll capture some of the data points given in the question. Some of them are of no use. As we do, you'll understand it. Approach without taxes. According to approach, if you follow without taxes, both firm will have same value. Both firm will have same value. First is equilibrium value for A and B. Answer is going to remain same. Value of equity and cost of equity. They have given value of firm 50 and 60. This is traditional approach. I don't have any use of that. Because traditional approach says cost of equity can change, value can change. So I'm not going to copy that. Net operating income is EBIT. Let me capture the data I need. 5,000 is EBIT. 5,000 is EBIT. Interest is 0. Cost of debt in rupees is nothing but interest. EBT. EBT is nothing but net income here. Tax is not that. Net income means PAT. They have given cost of equity, but this is traditional approach, so I cannot use this. They said equilibrium value of KE is 9.09. Equilibrium value of KE is 9.09. This is for a company which doesn't have borrowing. For a company, let me complete the company which doesn't have borrowing. Cost of equity given in the question. The A and B data is of no use because for approach, the cost of equity is 9.09. Not applicable. Same 9.09. Cost of equity and cost of capital will remain same. Same 9.09. Value of debt is 0. Value of firm. That formula which I said you will keep interchanging. EBIT divided by cost of capital. EBIT divided by cost of capital. EBIT by cost of capital. The value of firm is EBIT by cost. We had multiple formula. If you remember, these were the formula I had told you. Cost of debt is equal to interest by debt. Cost of equity is EBT by equity. And cost of capital is EBIT by firm. You can interchange this. So firm is equal to EBIT by KO. Equity is equal to EBT by cost of equity. You can keep interchanging the formula. Equity, either you apply the formula which is EBT by cost of equity or take it as balancing figure. What is balancing figure is debt plus equity is firm. So you'll get the same answer, 55,006. Value of firm for firm A is 55,006. Firm B will also be 55,006. Firm B will also be 55,006. Because under approach, if taxes are not there, both firms will have same value. If taxes are not there, both firms will have same value. Value of debt is there, 30,000. Equity balancing figure. Equity balancing figure, 25,006. Equities balancing figure, 25,006. Equities balancing figure, 25,006. I can use the formula and get all the three. Cost of debt, I had told you the formula here, interest by amount of debt. Cost of debt is interest by amount of debt. Cost of equity is EBT by value of equity. And firm is EBIT by value of firm. So very simple, straightforward format. ICI in the solution they made it a little complicated, but this is a very simple approach to do the calculation. Cost of debt is interest by value of debt. Cost of equity is EBT by value of equity. Cost of capital is EBIT by value of firm. EBIT by value of firm. If you have not followed my classes, you may find this slightly different. But students who have gone through my classes, they'll understand this is a very simple area. Question's requirement was equilibrium value of firm A and B 55,006 value of firm. Value of equity and cost of equity. Value of equity is 55,000 and 25,000. Cost of equity is 9.09 and 12.8. Cost of equity is 9.09 and 12.8. Whatever cost of equity given in the question, that will come for unlevered firm. For levered firm, cost of equity will go up because borrowing leads to more risk. Borrowing leads to more risk. I hope this is clear. If there are doubts, you can let me know. Any doubts, please let me know. Let's go to the next question. MR Limited is having the following capital structure, which is considered to be optimum as on 31/3/2022. Equity share capital, preference share capital, debentures. EPS were 2.5 in 2021. Expected growth is 10%. Next year DPS is 50%. Current market price is 25. 15% debentures can be issued. Currently selling at 96. 12% preference share can be sold. Applicable tax rate is 30%. You are required to calculate after tax cost of new debt, new preference and equity share capital, marginal cost of capital, how much can be spent for capital investment before sale of new equity share, assuming that retained earnings is 50% of 2021. Go through this question. Again, a problem which we have done in regular class. It's there in ICA study mat as well. This problem is there in the ICA set of questions. We have done this in the regular class. It was a past RTP or an exam question. Go through this. This is on WACC or WMCC, weighted marginal cost of capital. Okay, they've asked for one is after tax cost of new debt, new preference and equity capital, assuming it comes from retained earnings, basically no flotation cost. Marginal cost of capital, which is the cost of raising additional capital. Now, the first line of the question says it is considered to be optimum. Optimum means whatever money, marginal means additional, you will raise it in the same proportion. So the proportion is 8 lakh on 10 lakh, 80%, 5%, 15%. This is the proportion we will follow. 80, 5 and 15. 8 lakh on a base of 10 lakh, 50,000 on a base of 10 lakh and 1 lakh 50 on a base of 10 lakh. Any money to be raised, 80, 5 and 15 is the proportion. So let's start. Cost of new debt, new preference and equity share capital, assuming that it comes from retained earnings. Let's start. Cost of debt. Cost of debt KD is equal to, we'll first check whether it's a redeemable or an irredeemable debt. Currently selling at 96. Company 15% new debentures will be issued. 15% new debentures will be issued by the company. Life data is not there. So interest after tax by net proceeds. The existing debentures are of, okay, 15% only. The new debentures are also 15%. Existing also 15, new is also 15. Interest after tax 15 into 1 minus 15 into 1 minus the tax rate is your face value is 100 rupees assumption. Face value data is not given, but I'm assuming 100 because closer to 96. So 15 into 1 minus 30%. Net proceeds is equal to issue price minus flotation cost. I'm assuming the issue price to be equal to the current market price. Why current market price? Because it's the same debenture. 15% debenture only we are issuing. So logically, I'll issue it at the same price of 96. I'll issue it at the same price of 96. 10.50 by 96 into 100. We'll issue it at the same price. Same price. 10.5 by 96. 10.94%. Alternatively, you can take it as 100 also, but I think ICI did this, which to me looks little logical only. 10.94%. I'm assuming that I'll make the issue at the current market price. Next is cost of preference. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. We are planning to issue 12% debenture, sorry, 12% preference. Earlier was also 12% only, and it will be issued at a net price of 91.5. Issued at a net price of 91.5. So 12 by 91.5 into 100. 12 divided by 91.5 into 100. 13.11%. 13.11%. Cost of preference is 13.11%. AP is 13.11%. Cost of equity, technically cost of retained earnings, because they've said it will come from retained earnings. Anyway, formula is same. Will not assume any flotation cost here. Cost of equity, technically cost of retained earnings is equal to D1 by P0 plus growth rate. 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 EPS is 2.5. Next year growth will be 10%, and the dividend is expected to be for the next year. Next year dividend is 50% of 2021 EPS. 50% of whatever EPS you have reported. 50% of whatever EPS reported. Whatever EPS is reported. So 50% into 2.5 divided by current market prices 25. Growth rate is 10%. Growth rate is 10%. So 0.05 plus 0.10, 0.15 or 15%. 0.15 or 15%. That answers part 1 of the question. With that, we'll get part 2 also. 0.15 or 15%. 0.15 or 15%. Cost of equity or cost of retained earnings is 15%. 15%. Part 1 is done. Marginal cost of capital is the cost of raising additional money. Any money I raise, I'm going to raise it in the proportion of 85 and 15. The proportion is going to be 85 and 15. That's the proportion. Computation of WMCC, weighted marginal cost of capital, source, cost, weight, product, source cost weight product, source cost weight product, equity preference debentures total, equity preference debentures and total, equity preference debentures and total, cost of equity is 15%, cost of preference is 13.11, 10.94. Some rounding of gaps can come from our solution as compared to ICI. 15, 13.11 and 10.94. 15%, 13.11 and 10.94. Any money I raise, the proportion is going to be 85 and 15. 85 and 15. This is the proportion to be followed. Product is weight into cost. Weight into cost. Kind of done. Sum of product by sum of weights. Product is weight into cost, 80 into 15%, 5 into 13.11%, 15 into 10.94%. WMCC is equal to sum of product by sum of weight. I hope you are noting it along with me. Please do that. Into 100 to express in percentage, 14.3%. Note it. Let me know if there are doubts. I'll wait. 14.3%. 14.3%. WMCC is 14.3%. The WMCC number is 14.3%. Weighted marginal cost of capital is 14.3%. Hope this is done. And one more requirement is, how much can you spend for capital investment before sale of new equity shares, assuming that retained earnings for next year investment is 50% of 2021. Now, what they are saying is, how much can you spend for capital investment? See, assume I want to do a capex of 100. 80 will have to come from equity. I may have retained earnings of that much. Assume I want to do 1000. 800 is the equity portion. 10,000. 8,000 is the retained earnings. 1 lakh, 10 lakh. So as figures go up, your retained earnings will not be sufficient. So they are saying, how much can you do capital investment before sale of new equity share? That is, how much can you do investment with the available retained earnings? With the available retained earnings. So point number 8, total earnings of 2021. Total earnings of 2021 is equal to, the earnings per share is 2.5 and number of shares were 50,000. So 2.5 into 50,000. 1,25,000 is the total earnings. 1,25,000 is the total earnings of 2021. Total earnings of 2021 is 1,25,000. Retained earnings 1,25,000 into 50%, because we are retaining 50% and paying out the balance 50%, 62,500. That is, I can do 62,500 rupees of retained earnings. How much capex can be done? It's like this: retained earnings, capex. If you have retained earnings of 80 rupees, capex is 100. because 100 rupees of capex, 80 rupees is this. If you have this 800, this is 1000. I have this of 62,500. How much can be this? How much can be the capital investment? If you have 80 rupees of retained earnings, you can do a capex of 100. 80% is the equity portion. 80%. So capital investment with retained earnings is equal to 62,500 divided by 80%. Divided by 80%. 62,500 divided by 80%. 78,125 I can do with the available retained earnings. With the available. If you tell me to invest more than this, I will have to issue fresh shares, because my plan is to raise money in the proportion of 85 and 15. Raise money in the proportion of 85 and 15, because that's the optimum capital structure. That's the optimum structure. I think I can kind of done. Let's just check the solution as well. You get the same answer, 55,000, 25,000. Sometimes I say solution can have some deviation. 14.3, 78, 125. Theory questions I'm not discussing. You can just refer that. I think this video would give you the grip on your this paper. I know somewhere the student had a mindset that it was a tough paper, but I again feel that it was not very tough. Yes, some unique adjustments were there, but if you do proper preparation with conceptual clarity, you would have cracked this paper easily. Thank you, friends.